if you're completely new to investing, or even if you've been investing for some time now, with hundreds to over thousands of ETFs out there in the market, trying to decide which one to choose can be a bit overwhelming. Many people just want a simple and low maintenance investing approach. So in this video, I'll be talking about the one ETF that I choose to buy and hold forever if I could only pick one, and I'll explain all the reasons why so that it'll help you decide which one that would work best for you and your investing goals. So let's get started. First, I want to give you a breakdown of what is an ETF. ETF stands for Exchange Traded Funds. And simply put, an ETF is a fund that holds a collection or basket of stocks, bonds, or other assets. And ETFs can be bought and sold on a stock exchange just like an individual stock. Many ETFs track the performance of a specific index like the S&P 500, for example, while others may focus on specific asset classes or sectors. So things like technology, energy, healthcare, real estate, bonds, commodities, and more. So now that you have a better idea of what an ETF is, in order to pick one ETF to buy and hold forever, we need to know what to avoid. First, let's talk about the type of ETFs that we don't want to buy and hold forever. First is an ETF that is highly concentrated in only one sector. So, for example, these would be ETFs that are focused purely on technology, healthcare, semiconductors, banking, or any other specific industry. And while these type of ETFs can offer good returns when the sector is performing well, but when that sector takes a hit, so will your entire investment. Because of the lack of diversification, you lose any sort of downside protection that would come with a portfolio that's invested in a variety of sectors and stocks. This also falls in line with the second one, which is specialty and covered call ETFs. One type of specialty ETF is leveraged ETFs. To keep it simple, they provide multiples such as 2x or 3x of the daily performance of an index. So imagine the movements of the S&P 500 on a daily level, but with 3x the return. Things could go upside down real fast. Another example is when it comes to something like covered call ETFs. These ETFs will invest in a portfolio of stocks while also selling call options on the stocks in that portfolio. While these ETFs provide you with income from the premiums of those options, this sacrifices long-term growth and they underperform their underlying assets in a rising market. And if we had to pick one ETF forever, we don't want limited upside potential, nor do we want any additional risk. But now that we've talked about what we should avoid, let's get into what we need. Next is the criteria for this one ETF. A solid one ETF portfolio is going to need to meet a few requirements. First is going to be diversification, as the ETF will need to have some decent level of diversification with holdings from a variety of stocks and sectors. Second is a strong historical track record. So I want to see something that has 10 to 15 years or more of historical performance so that we have a much better idea of how it performed over various times in the market. And third, it needs to have low fees, so a low expense ratio below 0.25%. These costs are what the fund charges to cover their management, administrative, and other operating expenses. The lower the better on this one, since that's more money that you get to keep in your pocket. Now, there are only 3 ETF types that meet the criteria that I broke this down into, which we'll be going through each one of them, and the categories that we'll be looking at include diversification, future return potential, volatility, and risk. And we'll be comparing each of these ETFs on a scale from 1 to 5, with 5 being the highest rating, meaning it's the strongest here, and 1 being the lowest, representing weakness. First up is broad market or S&P 500 ETFs. These broad market ETFs give you exposure to a wide range of companies, industries, and even countries. Here's a list of some that you can take a look through later. Some great ones that I like include VOO, which is Vanguard's S&P 500 ETF, which tracks the S&P 500 index, VTI, Vanguard's total US stock market ETF, for exposure to all the stocks in the US, and VT, Vanguard's Total World Stock ETF, which contains every investable stock in the world, so all US and international stocks. Getting into the first category, diversification, I'm giving these ETFs a perfect 5. That's because they offer a wide variety of stocks that give you exposure to many different industries and sectors, and with the total market funds, you're in essence getting exposure to every stock in the world. As for the potential future returns, I'm giving this one a 4 because these type of funds provide you with solid growth and long-term consistent returns, and they aren't expected to provide crazy returns and outperform the market, but at the same time not underperform the overall market as well. Next, for volatility, I'll be giving it a 3. And if you didn't know, volatility refers to how quickly an asset's price fluctuates or moves up and down over time. These broad market ETFs have a history of reliable returns over the long run through corrections, bear markets, and bull markets, which over time we experience more often. But this doesn't take away the fact that these funds are still vulnerable to swings in the market, just not as sharp and quick as more aggressive ETFs. Getting into risk, I'm also giving it a 3. These broad market funds are composed of stocks. Now, whether that's stocks in the S&P 500, all the US stocks, or all the global stocks, they're all still stocks at the end of the day, and there's no stock that's going to be 100% risk-free. The diversification here does help in the case if there are certain industries or sectors that are taking a hit, the fund can help offset it with its other holdings. But in reality, if you want low risk, this is where money market funds, bonds, high-yield savings accounts, treasury securities, and other conservative assets come into play. The second ETF type is going to be dividend ETFs. For those looking for diversification, consistent and stable returns, along with some income generation, then these ETFs will be right up your alley. Here's a list of a few that you can look into. Some of my favorite high-quality dividend ETFs include schd, the Schwab US Dividend Equity ETF, which is a great overall dividend ETF and one of my favorites. Then DGROW, which is the iShares Core Dividend ETF, and its focus more towards dividend growth. And VYM, the Vanguard High Dividend Yield ETF, which offers great stability and a solid dividend yield. For the first category, diversification is a 4. While dividend ETFs can offer a wide variety of stocks and exposure to sectors, it will be more dependent on the specific ETF, but typically there's more concentration in sectors that are known for their dividend stability. The next category, future return potential, I'm going to be giving it a 3. While some dividend ETFs can provide really good returns, oftentimes they're not going to be outperforming the broad market ETFs. One thing to keep in mind is that dividends are a portion of a company's profits that are paid out to shareholders, while non-dividend paying stocks are reinvesting these earnings back into the business to further fuel growth and expansion. Dividend-paying companies tend to be more conservative here. For that reason, the potential for growth can be capped some. For volatility, I'm giving a 4 here, since the companies that typically pay out dividends are mature, large, and more established companies that have a strong history of stable earnings, cash flow, and are financially solid. As well as if you take a look at the betas of dividend ETFs, you'll see that they're lower than broad market ETFs, further supporting that these dividend funds tend to be less volatile. Last, for risk, I gave this one a 3, matching with broad markets. While these funds can offer some great stability, that doesn't make them immune to risk. As I mentioned earlier, many of these dividend ETFs are pretty heavily exposed to specific industries with a dividend track record, which can bring up the problem of sector concentration. This targeted focus can make you less diversified and a bit more vulnerable to sector-specific risk, but it shouldn't scare you at all. It's just something to be aware of, since many dividend ETFs are defensive in nature and offer solid stability. This next ETF type is going to be growth ETFs. These funds invest in companies with the potential for beyond average growth that are rapidly expanding their businesses, market share, and revenues. And this is appealing for those that are looking to really maximize the earning potential of their portfolio. This includes companies in technology that you're likely familiar with, such as the ones in the Magnificent Seven, like Apple, Microsoft, Amazon, Google, and more, as well as sectors like communication, healthcare, and others. Here's a list of some that you can look into. A few of my favorite growth ETFs include SCHG, the Schwab US Large Cap Growth ETF, VUG, the Vanguard Growth ETF, which these both invest in large cap companies, and then QQQM, the Invesco NASDAQ 100 ETF, invest in the largest 100 non-financial companies, and the NASDAQ index. So for diversification, I'm only going to be giving it a 2 here. And the reason why is because these growth funds are going to be more limited in sector exposure and heavily leaning towards innovative and technology companies. When it comes to future return potential of growth ETFs, I have no choice but to give this a 5 here, as growth ETFs have provided some pretty amazing returns. For example, if we take a look at the returns of the growth ETFs that I mentioned earlier, you can see ETFs like schd have had some solid returns over just the last 5 years, and this is considering the recent drawdowns we've had since the start of the year. But speaking of drawdowns, this brings me to giving 2 points for volatility. While growth can provide you with exceptional returns, they can also drop as quickly as they go up. This means the potential for much more volatility with larger price movements due to their high valuations, an earning miss, or market sentiment, since downturns can lead investors to shift to safer and less risky assets. This is also supported by the fact that the betas for these ETFs are higher than broad market and dividend ETFs. This ultimately leads to more risk, which is why I'm also giving it 2 points here. The reason is these funds are less diversified and have more concentration in tech and other volatile stocks, as well as your opportunity for losses are going to be much higher. These types of ETFs are likely to suit investors not only with a higher risk tolerance in general, but also with a longer investing time horizon. So now that we've gone through these 3 categories, let's take a look at all the results. Based on what we see here, I'd say if I had to choose an ETF and I can only pick one to invest in forever, I'd have to go with the broad market funds. Although dividend ETFs come in really close here. With the proven historical track record of the S&P 500 or the total US stock market as a whole, the return that is given over the time, along with this level of diversification and moderately balanced risk, is just hard to beat. But I will say there is a lot of potential in some of these dividend ETFs, as some of them are able to offer some nice appreciation along with that dividend income that has the potential to snowball into some serious income and value down the road. Now, the best part about all of this is the fact that you don't need to only invest in one ETF, so you're able to take advantage of all the benefits and opportunities of more than just one ETF. And if you want to see some more options for dividend ETFs, check out this video here or this video here to see how $19 a day in schd could earn you a full-time income. If you made it this far, thank you for watching. It really means a lot, and I'll be seeing you on the next one.